With $10,000, you've become a man who knows how to save. With $20,000, you become an investor. James Capital. Why things change even more after $20,000. Picture this. You've finally crossed that first big hurdle. You've got $10,000 tucked away in your high-yield savings account, or maybe even starting to dip into a Roth IRA. The midnight panics have dialed down a notch. That check engine light doesn't send you into a spiral anymore. You're sleeping a bit better, negotiating a little harder at work, and maybe even eyeing that certification course you've been putting off. Life feels manageable. But here's the thing. It's just the beginning. What if I told you there's a next level where the changes accelerate exponentially? Where survival mode fully gives way to growth mode, and your money starts working harder for you than you ever worked for it? Most people stop at the basics. They hear about emergency funds covering 3 to 6 months of expenses and think that's the end game for security. Financial advisors might push for $50,000 or even $100,000 as the real milestone. But the truth, the raw psychological and mathematical truth, is that the second massive shift hits right around $20,000. It's where the momentum really kicks in, turning your financial life from an uphill slog into a downhill coast. My name is James. I spend way too much time thinking about money, human psychology, compound interest, identity shifts, and why some people build wealth effortlessly while others grind forever without breaking through. If you've ever wondered why hitting certain savings levels feels like unlocking superpowers, and specifically why $20,000 takes everything from the $10,000 level and amplifies it, stick with me. And if this video clears things up or fires you up, hit that subscribe button and drop a thumbs up. It really helps. Before we dive into why $20,000 is the accelerator pedal, let's recap what life looks like before you get there. Even if you've hit $10,000, you might still recognize some of this. You're no longer in pure panic mode, but there's still that lingering scarcity mindset. You're careful with every dollar because, while $10,000 covers most emergencies, it's not quite enough to feel truly free. Job loss for more than a couple months? That could wipe it out if your expenses run $3,000 to $4,000 a month. A major home repair like a new roof or HVAC system? You're dipping deep. You're proactive, sure, but not aggressive. Opportunities come up. A side hustle that needs $5,000 startup cash, a real estate seminar in Vegas, or even a family vacation. And you hesitate. What if something goes wrong? The buffer is there, but it's thin. You're playing defense with occasional offense, not full court press. And the mental side? At $10,000, stress is lower, but it's not gone. Decision fatigue lingers on bigger choices. Should you max out your 401k match or keep more liquid? Invest in stocks or play it safe with CDS? You're confident, but not bold. Socially, you're showing up more. But that quiet envy when friends talk about their brokerage accounts or rental properties still creeps in. You're out of the trenches, but not on the mountaintop. But then, you hit $20,000. It's not fireworks this time either. Maybe a quiet fist pump when you check your app. But internally, it's like upgrading from economy to business class. Everything from the $10,000 level gets supercharged. The changes aren't just additive, they're multiplicative. Let's break it down. First, your relationship with risk evolves from manageable to strategic. At $10,000, risks felt doable but still nerve-wracking. Now, with double the buffer, they feel exciting. You're not just asking for a raise, you're negotiating a full compensation package, including stock options or remote work perks. That side hustle? You're investing real money into it. Maybe $2,000 for inventory or marketing. Relocating for a better job market? You're running the numbers on moving costs without sweating it. Psychologists call this risk tolerance expansion. With $20,000, your brain shifts from what if I lose to what if I win. Studies from Vanguard show that people with 6+ months of expenses saved, often around $20,000 for average Americans, are 30% more likely to pursue entrepreneurial ventures or career pivots. You're not reckless, you're calculated. The safety net is now a launch pad. Second, your stress levels plummet even further, unlocking peak performance. At $10,000, cortisol dipped, but at $20,000, it's practically vacation mode. Neuro research from Harvard indicates that financial cushions above 6 months correlate with 25 to 40% reductions in chronic stress markers. Sleep improves dramatically. Insomnia linked to money worries drops off. Focus at work sharpens. You're not distracted by what-if scenarios. Patience with family skyrockets. Even physical health benefits. Lower blood pressure, better immune response. Imagine a $4,500 medical bill from an unexpected ER visit for appendicitis. At $10,000, it's covered but leaves you exposed. At $20,000, it's a blip. You pay it, recover, and keep building. This low-stress state frees up cognitive bandwidth for creativity and problem-solving, turning you into a high performer in every area. Third, the emergency fund effect goes from protective to generative. Remember, at $10,000, the power was in knowing you could handle crises. Now, at $20,000, it's about creating abundance. You rarely touch it for emergencies. Instead, it's fuel for growth. Split it mentally. $10,000 for pure safety. $10,000 for opportunity. You're funding that Airbnb side hustle, buying rental property leads, or even angel investing in a friend's startup, with due diligence, of course. Financial experts like Ramit Sethi call this the wealth snowball. Your money starts attracting more money. You're not just surviving disruptions, you're leveraging calm periods to compound. Fourth, confidence turns into charisma and influence. At $10,000, you negotiated better. At $20,000, you lead. You walk into interviews like you own the room, knowing you could walk away and survive 6 to 8 months. Managers notice. Promotions come faster. In relationships, you're more generous, picking up tabs without resentment, planning trips without skimping. Socially, that less than feeling evaporates. Friends start asking you for advice on apps like Acorns or Vanguard. This isn't arrogance, it's quiet power. Research from the Journal of Personality and Social Psychology shows financial security boosts perceived leadership traits by 20 to 30%. You become the person others follow. Fifth, decision fatigue doesn't just collapse, it vanishes. At $10,000, micro decisions eased up. Now, even macro ones flow. You're not agonizing over $200 concert tickets or $500 weekend getaways. Mental energy shifts to optimization. Automating 401k contributions, shopping for better car insurance rates, saving $100 per month, or refinancing student loans. You're strategic about big spends. Housing, vehicles, education, factoring opportunity costs. If I buy this $30,000 car, that's $30,000, not growing at 7% in an S&P 500 fund. This mindset, per behavioral economists, leads to 15 to 25% higher lifetime wealth accumulation. Sixth, money becomes an active ally, not just a tool. At $10,000, you saw money as generative. At $20,000, it starts generating noticeably. Math kicks in. 8% annual return on $20,000 is $1,600 per year. Free money. You're diversifying. Some in high-yield savings, 4 to 5% APY via Ally or Capital One. Some in index funds, Vanguard VTI. Compound interest accelerates. Saving $500 per month? Your first $20,000 took approximately 3 years. The next takes approximately 2.5 because earnings help. You're exploring tax advantages, maxing HSA contributions for healthcare, or Roth conversions. This isn't rich people stuff. It's accessible via apps like Fidelity or Robinhood. You're not chasing get rich quick. You're building a machine. Seventh, practical coverage expands to near invulnerability. Real U.S. stats. $20,000 handles everything $10,000 did, plus bigger hits. Extended job loss. 6 to 9 months at $3,000 per month expenses, covered. Major surgery copay, $5,000 to $10,000 even with insurance, handled. Home flood damage, $8,000 deductible, no sweat. Family emergencies like helping parents with $7,000 assisted living costs, possible without debt. Per the Federal Reserve, households with $20,000 plus liquid assets are 40% less likely to fall into credit card debt cycles. You're immune to 90% of financial shocks that derail middle-class Americans. Now, the core magic, the amplified identity shift. At $10,000, you became a saver. At $20,000, you're an investor. You've proven consistency twice over. Habits are ironclad. You view yourself as wealth-building capable. This self-concept, per identity research from Stanford, drives 70% of financial behaviors. You attract better opportunities, networking events, masterminds, even mentors. Scarcity mindset? Gone. Abundance reigns. But $20,000 isn't magic without action. Many hit it and stall, blowing on lifestyle creep like a bigger TV or fancier car. Resist. Use it as rocket fuel. Addressing the doubt. $20,000 feels far if I'm at $10,000. Fair. But momentum from the first $10,000 carries you. Start compounding. Auto transfer $200 to $300 per month to investments. Cut one habit. Streaming bundles, $15 per month lunches. Side hustle via Uber Eats or Etsy. Job hop for 10 to 20% raise. At $500 per month plus 7% returns, $20,000 arrives in 2 to 3 years. Socially, everything elevates. No more dodging invites. You're hosting, gifting, collaborating. Relationships deepen without money tension. Bottom line, $20,000 doesn't make you wealthy, but it supercharges the $10,000 changes, turning security into acceleration, confidence into leadership, tools into engines. It's where reacting ends and designing begins. If you're chasing $20,000, start now. Build on your foundation. Drop a comment. Under $20,000, just hit it or beyond. Subscribe for more milestone breakdowns. See you next time.